Good afternoon to everyone who has joined on this call, and thank you for joining. At the outset, I will start by thanking all the stakeholders for having supported us throughout our journey of 28 years as we cross a very important milestone of 10,000 crores in AUM. I think as you remember last time I had shared with all of you that we are a striking distance away from our important milestone of 10,000 crores and that we could complete it in December on a concerted basis. We were around 10,200 crores and we are very happy to share with the same with all of you. I'm more happy to share that this growth has been on a very fundamentally strong balance sheet. With 25 years of experience, with capital adequacies of more than 24%, with a very with asset quality well maintained, and with a diversified asset and a diversified liability mix, and add to that a very prudent and business model whereby we are adequately leveraged. At the same time, we generate good CAGR on growth. We generate good return on capital employed, and that is what I personally understand, being a practitioner for more than 30 years, are the ingredients for sustainability and scalability. So we differentiate ourselves here whereby we are on a very strong footing as far as the fundamentals are concerned, and we are going for, as we enter the next phase of growth, we are very confident that with these fundamentals and with an attitude of always learning, unlearning and relearning. That is what I was sharing with Abhijit, that at Mass there is no sense of complacency. We understand that we have miles to go and we have to improve on so many accounts, and we are continuously working on that. So we are on a very strong fundamental, have given a very strong result over all these 28 years, translating into a close to a 36% CAGR and a commensurating profitability also, having utilized the capital very judiciously. As you know, we had a non-dilutive growth so far, and going forward also the capital will be used very judiciously. As all of you are aware that we also have an enabling resolution to raise 700 crores as and when required. If you see our capital adequacy is very strong, so this enabling resolution is for the next phase of growth, and that we will evaluate from time to time the opportune time and the opportune amount, maybe in single or more tranches, for the funds to be raised to further strengthen the balance sheet and further fuel the growth, that too in a very fundamentally strong manner. Without taking much of your time, if I just focus on few of the basic aspects of our business. So as I shared with you, on the asset side, we are a more diversified, we are moving towards becoming a more diversified asset company with around, if you see a YOY growth of 27%, if you see the working of this quarter, we have grown our AUM by 27%, profitability by 24.15%, and if you see this 27% growth, around 60% comes from our flagship product, that is MSME, and the 40% product comes from other products. So we are heading towards a more diversified asset base. In terms of liability, we have a very strong record of more than 28 years on liability. With risk of sounding immodest, we always have a problem on how to satisfy the sanctions we have on hand rather than how to meet the liability targets. But having said that, we are now more focusing with the new trends emerging in terms of diversification of liability. As far as NBFCs are concerned, we are aware of the fact and we are looking at diversifying our liability also, and within next 3 to 5 years we see this as diversified as our assets. In terms of operations, we are continuously, I always share with you that we are aware of the fact that technology plays a very important role in efficient operations, and we are working hard on that. And we have an internal team. We have an internal team of more than 70 people working, including the business analyst team. And we are from time to time launching various loan origination programs for various products progressively, accompanied by a very strong and a very time-tested LMS. So we have an enabling technology, the capabilities at place to commensurate the future growth, and nevertheless there also we are not complacent. We are trying to team along with the help of the outside vendors from time to time. Brief on the most important aspect of any organization, the human resources. We continue to enjoy the confidence of the core team and the team at the higher level, at the top and the middle level, with approximately more than 500 people still with us for more than 5 years. The top core team with me since more than 25 years. The testimony to the fact that we believe in growing together, and going forward, this is going to be one of the biggest enabler as far as this company is concerned. In terms of distribution of assets, I am happy to share that we are diversifying there also. We have two types of distribution. One is through our direct distribution through our 181 branches touching close to 11,000 touch points, and with another more than 100 NBFCs. Both of them have worked very nicely for us. While our distribution through NBFC has been very robust, NBFCs have proved themselves to be a very efficient intermediary. But as I've always said, our direct distribution is growing faster than the distribution through NBFC, and hence we will see progressively our direct distribution to be settling anywhere close to 70-75% in next 2 to 3 years. I'm very happy to share that we had declared a dividend and a bonus both for rewarding the shareholders for their commitment towards the company. We as Team Mass remain committed to our goal of excellence through endeavors and enhancing the stakeholders' value. We are in the process of strengthening all the aspects of the business as we enter the next phase of growth, and I'm sure that next decade will be very different on scale from what we have seen Mass during last 28 years. So with this, I will request Darshaven to take you through numbers quickly, and then followed by Ankit talking about the liability performance during the quarter, and I'll be keen to take your queries thereafter. Over to you, Darshaven.
Yeah, thank you, sir. Good afternoon, everyone. So we are once again very happy to present a robust number for Q3 financial year 24. As Kamlesh sir shared that we have crossed the milestone of 10,000 crores of AUM on consolidated basis. So as on 31st December 23, our AUM on consolidated basis is 10,216 crores as compared to 8,004 crores as on December 22, which is 27.63% rise in AUM. As far as consolidated PAT is concerned, it is 64 crore 41 lakhs as compared to 51 crore 88 lakhs as on December 22, which is 24.15% increase in PAT. If we look at the portfolio configuration of the parent company, our AUM as on December 23 is 9,672 crore, which is 27.16% increase in AUM on standalone basis. So it was 7,606 crore in December 22. If we look at the configuration, MEL and SME contributes around 80%. To Wheels is contributing 14%, and SPL is around 5.44%. So MEL portfolio has grown by 15.03% from 3,777 crore to 4,344 crore. SME loan, there is a growth of 21.46% from 2,840 crore to 3,450 crore. Two-wheeler loan has grown by 34% from 501 crore to 670 crore. Commercial vehicle and salaried personal loan being the lower base, now CV portfolio is at 661 crore. It was 291 crore as on December 22, and salaried personal loan is 544 crore. It was 194 crore as on December 22. If we look at the income and profitability numbers, there is a growth of 29.55% growth in our total income from 251 crore 47 lakhs to 325 crore 77 lakhs. PBT on quarterly basis has increased by 25.05% from 67.58 crore to 84.51 crore. PAT has increased by 23.52 from 50.55 crore to 62.44 crore. If we look at the 9 months numbers, income has increased by 33.17% from 679 crore to 904 crore. PBT has increased by 70% from 194 crore to 240 crore. And PAT has increased by 23.58% from 145 crore to 179.70 crore. And as sir mentioned that we could maintain the quality of the portfolio, the gross stage 3 asset is 2.23% as compared to 2.17% as on September 23, and net stage 3 is 1.48% as compared to 1.47% as on September 23. And we still hold around 19 crore as a management overlay, which is 0.25% of our total on-book asset. Now coming to the housing performance.
I'm sorry, I missed out on sharing with you on the development on housing, which is very important. And I'm very happy to share that we could grow the housing book by 36% as we had projected last time. And I continue to share the confidence that this portfolio will grow by 30 to 35% going forward while maintaining the quality of the assets, strong capital adequacy, and a very fundamentally strong balance sheet. So housing going forward will play a very important role in the overall growth of the company, and will be contributing anywhere between 10 to 20% within the next 3 years. And we are seeing a very robust growth opportunities there. And having said that, while Dashrath will share the detailed numbers, will give the idea of the quality of the portfolio and all, but we have maintained an immaculate portfolio quality there also. So housing is going to be one of the big enablers for the overall growth of the group. Sorry, Dashrath will take over.
Yes. So, our AUM in housing finance is, as on December 23, is 544 crore as compared to 399 crore, which is 36.50% growth in AUM. Total income on Q-on-Q basis, it has increased by 50.57%, so from 10 crore 91 lakhs to 16 crore 42 lakhs. Profit before tax has increased by 37.05% from 1 crore 80 lakhs to 2 crore 47 lakhs, and PAT has increased by 39.77% from 1 crore 44 lakhs to 2 crore. If we look at the quality of the portfolio, the gross stage 3 asset as on December 23 is 0.81% as compared to 0.79% in September 23. And net stage 3 asset is 0.58% as compared to 0.55% as on September 23. Here also we hold around 3 crore as a management overlay, which is 0.72% of our total on-book assets. So this was regarding the performance in our housing finance company, and now I'll request Ankit to take you through the capital and liability management.
Yeah, thank you, ma'am. And good afternoon to all. With respect to liability management, during the quarter we were able to maintain an average liquidity of around 800 crore with an unutilized cash sales facility which adds to the liquidity or at around 300 crore. In addition, the company as on 31st December has sanction on hand to the tune of 2,000 crore through various instruments, that is term loan, NCD, direct assignment and co-lending. In the last quarter, company did around rupees 550 crore direct assignment transaction with various banks, and the company further has more than 900 crore sanction on hand, which will be utilized during the quarter and next year. The company aims to maintain around 20-25% of AUM as off-book through direct assignment and co-lending. Company was able to maintain a cash facility of 1,715 crore, out of which the average utilization was 75 to 80%, and rest portion was kept as a liquidity buffer. We raised around 670 crore term loan during the quarter with an average maturity of 3 to 5 years, thus is further strengthening the asset liability maturity pattern of the company. We are well placed or strongly placed with respect to structural liquidity for the period ended 31st December, and whereby liquidity is adequate and cash flow is in all the cumulative buckets is positive. The capital adequacy remains strong at 24.47% with Tier 1 capital of 20.59% and a debt equity of 3.99 times. The cost of borrowing for the quarter was at 9.86%. The cost of borrowing for the September quarter last year was 9.32%, and this increase of 0.4% is majorly because of lag effect of MCLR increase by banks. As per the current sanction on hand through various instruments, we have already tied up for the fund requirement of the current year and parked for the next financial year, and our efforts is focused toward further diversification of sources of fund and to maintain the cost of borrowing. Thank you. Now we are open for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Hardik Doshi from White Whale Partners. Please go ahead.
Yeah, thank you for taking my question. Firstly, I think on the call you mentioned that you would raise the capital as and when required and possibly in tranches. Any kind of particular timeline that you're looking at or you thought about? Would it be in the next quarter, next 6 months, next 1 year?
So it will depend once we discuss this with the merchant bankers and we start meeting the investors. So if we get the right valuations and the right set of investors, it can be done soon. Otherwise, we can wait for the opportune time, because as you know that we are already well capitalized, and the idea to have this enabling resolution is to have sufficient time to choose and pick the right set of investors for us. So it all depends. Once it has been recently passed, so we'll have the interaction with the merchant bankers on that, and then meet the investors and see what will be the right time and the valuations to raise.
Okay. Just on that, you mentioned you're sufficiently capitalized and, our Tier 1 is also well over 20%, so which is above the benchmark and quite comfortable. So, why don't we kind of wait for a little while longer before looking to raise this capital?
See, as I have shared a number of times that when we talk about capital adequacy, we usually talk on overall AUM. When we are talking about a 20% capital adequacy and a 24% in all, it is on the on-balance sheet assets. So we would like to maintain capital overall on AUM, and hence we have taken this enabling resolution. So once we say, for example, in next 3.5 years, if we double the AUM, we may require capital if we have the fundamentals of raising and keeping the capital on total AUM. And hence we took this resolution.
Okay. But on the other side, if we look at it from the total AUM and then our ROAs and the leverage, this fundamentally would kind of stop us from crossing, above 20% in terms of ROE, right? Just doing the math with the leverage and ROE. So is that something, is that what we are comfortable with in like having high teens ROE?
Yeah. So I think let me share with you with the recent changes, regulatory changes and the dynamic regulatory changes that happens from time to time. It is always good to have some buffer in capital, And secondly, with the leverage where the lenders are comfortable and where you get a competitive rate is anywhere between 4 to 4.5 times. And then we de-risk to the tune of 20%. So I think we are looking at an ROAs in medium to long term anywhere between 16 to 18% as I look at now.
Okay. Just two more questions. One is on, our MSME, SME book overall, the growth is now less than 20%. And if you look at the MSME or the micro SME, it's like even 15%. Is there any kind of concerns that you are seeing or, any caution that has caused this deceleration?
So see, as I told in the opening remark that we would like to be a well diversified asset company as we grow. And if you see that MEL and SME is growing at a very healthy pace even on a very large scale. MEL is almost 4,500 crores, SME is around 3,500 crores and registering a 20% plus growth on SME and 15% plus growth on MEL. Itself shows our confidence in the product. So while we have sufficient confidence in the product, but at the same time, with economy entering a phase of a steady growth now, we see the Wheels portfolio and the home loans portfolio also contributing meaningfully. So we would have our focus and allocation of capital both on diversification of assets and the risk-adjusted returns. So taking all these things into account, I think we will see, as I shared, that around 10 to 15% in medium term will come from housing, or around 20%, 25% should come from Wheels, and the rest should come from MSME. And even in the last quarter of the total growth, 60% of the growth has been contributed by MSME. So we continue to have the confidence in our flagship product, but at the same time, we would like to diversify the assets also.
Okay. And just lastly, can you comment, MSME, SMEs have been seeing a pretty good asset quality cycle for, the last couple of years now, and, the economy is doing well, but, just seeing some of the results coming out from lenders in this segment, it seems like asset quality bottoming out, maybe even inching up. What are you seeing on the ground, and how are trends for you?
I think not now. Throughout the cycles, and right now where the cycle looks very benign is the time where you have to be more circumspect. As MSME is a very huge market to be served. So the question is never about asset creation, but about the asset quality. And this asset quality is subjective. It cannot be good for all or bad for all. So what we have seen as a practitioner over all these years, that if you extend credit where it is due, you don't chase growth, and you have a fundamental of not just determining growth but also discovering growth from time to time and holding on to the fundamentals of extending credit where it is due. I think you will have a good asset quality throughout the cycles. So now it's a very benign cycle going on since last at least 2 years post-COVID for MSME. But the lenders have to be more circumspect right now of not looking the other way as far as the credit filters are concerned. So it will be different for different companies going forward.
Got it. Okay. Thanks so much.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have a next question from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good afternoon, sir, and congratulations on a decent set of numbers. Sir, the first question is, so given this fundraise, now given that our ROEs are much lesser than the growth rates that we have been doing in the last many quarters, it would be, and given your prudence, I think it is, it's not very far away, right? Given where we stand in capital adequacy and where your ambitions are, and given the growth rate. So it can't be more than 1-2 quarters away at the most.
Yes, true. We would like to raise it, as I told, at an opportune time within this quarter, next quarter, or maybe a quarter thereafter. But we have got a time. If we get the right, I will repeat, if we get the right set of investors and the valuations are acceptable, we will definitely like to add on to the capital and make the capital base strong. because as a lender, we focus on making the balance sheet very fundamentally strong and raise capital ahead than what it is required. So you are right in a sense that it can be around the corner within a quarter or two.
And secondly, on this bonus issue, sir, what are the timelines for the same?
I think the record date is 22nd Feb. What is the timeline?
22nd Feb.
The record date is 22nd February.
EGM is on 9th Feb.
And the EGM is on the 9th February.
The bonus shares be credited?
So within 7 days after 22nd Feb.
Okay.
It should be before by the end of February.
Understood. Now, sir, on the housing part, so we have been there for a very long time, but it was broadly sort of never contributing meaningfully to the overall sort of company's growth as such. So what has changed now that you feel that it can be accelerated at a pace much higher than the other assets, thereby contributing to a larger share of the mix of the business? So is there any changes that you see in the environment, or what has changed while, now you are saying finally that, okay, we will now grow it at a much more aggressive pace?
It's all about our readiness from the operational point of view, from understanding the demography, because while we know the demography serving our conventional products, housing is a different ball game. And if you see that we always take time for the initial 1,000 crores of assets to be reached, because we don't believe in burning cash. We want to be profitable throughout. So we need to be aware, much cautious about the operational cost, about the credit cost. So we initially take time to understand demography, build up the teams who can understand our philosophy. And once that is done, we can really launch ourselves for the growth what we intend to. So all these years we were in the phase of understanding those things, and 2 years lost because of COVID, where it was not the right time to accelerate growth. So now we are ready. I will say that markets were there, but now we are ready to increase our market share, and maybe at this size market share does not really be significant, but increase the. So I don't know when it got dropped, but what I was telling was that now we are ready for this type of growth. Opportunities are always there.
So it has got nothing to do with the change or somewhat upward movement that we are seeing in general in real estate and the business environment. It is more to do with your own internal factors why you feel that you are now ready to accelerate.
Correct.
Understood.
Market is too huge for our size.
Yeah. And sir, finally, what we have been seeing is your AUM is growing at a faster pace than your PAT. And one of the reasons might be higher provisioning, because now the mix is being changed towards your own branches and all that. So by when do we see this to be getting stable, whereby we can grow both bottom line and AUM at the same pace?
There is hardly any difference, and that it's very difficult to match apple to apple. If it is 27% growth in AUM and 24% growth in profitability, I think that much lag will happen because of the operational cost, getting ready for the next phase of growth, seeing a critical mass at every phase of investment in operations, technology, and other resources. So I think we are almost there, and there will be always be some lag between the two if we are getting ready for the future every quarter.
Thank you, sir. All the best.
Thank you. We have our next question from the line of Madhuchanda Dey from MC Pro. Please go ahead.
Hi, I have 4 questions. The first question is, there has been increase in risk weightage on NBFC lending, and you have a substantial portion of your book from bank borrowing. But we have not seen that impacting your interest margin so far. Any color that you can throw on the same?
If you read the circular, the increase in the risk weightage for on lending to NBFC is in the other than is on the other than priority sector lending. So all the loans that bank lends to us is for on lending in priority sector. So if you understand the circular, it is
Okay, got it.
priority sector lending, on lending to NBFC has been exempted. So
Okay.
as far as the banks are concerned, they have no reason to increase our rate of interest. But having said that, under the guise of overall increase, there is some 5, 10, 15 basis rise being contemplated here or there. But we are in fact technically and practically not affected by that circular.
So, I mean, there has been, as per my calculation, there's been a slight uptick in NIM sequentially. I mean, how is that correct, first of all?
Yeah, because as we move more towards retail, I think while we have seen over all these years that the direct and the indirect retail assets channel were almost close to each other in terms of NIMs. But as we grow our retail portfolio, there will be slight difference in the NIMs going forward. So it is very marginal uptick in the NIMs.
Which means what you're trying to say is, in fact, the impact on the ROA will be same. The NIM will be slightly higher, and the cost will also be slightly higher in your direct channel. Is that a correct understanding?
Right.
Okay. My other question is on your housing book. So I know that this is absolutely in the build-up phase, so we can't read much into that. But here, what we see is the growth in the loan book is much ahead of the growth in profit. So, is it cost? Is it provision? Because those details we don't have in your presentation. And what is the sustainable steady state ROA of this business?
So we will share that the details with you. And just to give you a color on that, the profit not catching up with the growth and lagging behind is only because of the operational. So once again, what I was telling was that it is because of the higher operational cost being in the build-up phase, and on a steady state basis, we see the ROAs in housing finance company at around between 2 to 2.5%.
Okay. And I have a last question. In your prepared remark, you mentioned that next decade will be very different on scale. If you can throw some more light, what is that you're trying to convey by saying it will be different on scale?
So what I'm really trying to convey here is that if we were 1,000 to 10,000, we were just 1,000 crores, and with all this hard work, we were 1,000 crores in 2013. So as such, we started with 2 crores. So last 28 years was from 2 crores to 10,000 crores. But now next 10 years, if we do what we have done, maybe at a slighter, slower pace on a scale, this 10,000 crores will look substantially bigger. So that is what I mean to say, that it will be substantially bigger as compared to what we have done over all these years. Just to give you an example, we took 28 years to reach the first 10,000 crores, but the next 10,000 crores will be within next 3 to 4 years. So this is what I was trying to reflect upon.
Got it. And sir, the very last question is, do you plan to introduce any other product beyond what you have now?
I think we are working hard to have our used car product at place. I think we are running around a couple of quarters late in developing that product, but we are confident. We might take few more quarters to develop that, but we are confident given the market size and given our understanding of the borrowers, because we will sell to the same middle income group borrowers. So we would like to develop that product. Right now that is clubbed with CV because it is not substantial in number to be hived off as a special product, but we will see used cars as a product.
Thanks, sir. Thanks a lot for answering all my questions.
Thank you.
Thank you. We have a next question from the line of Bhargav from Ambit Asset Management. Please go ahead.
Yeah, good evening, team, and thank you for the opportunity.
So you're not very clear. Can you use your handset mode, please?
Hello?
Yes. Please go ahead.
Yeah.
Yeah. Yeah. Sir, in your presentation, you mentioned that you want to increase on the direct distribution to about 75 odd percent. So in terms of number of branches, what could be the number which one can expect maybe in the next couple of years?
I think we are at currently around 181 branches, and I think within next 2 years, if we take around 24, 25 and 25, 26, we should be doubling our branches in this 2 years, from 181 to close to 300 or 300 plus.
Okay. Okay, understood. And as of now, if you look at your branches, 90% of branches are in 4 states. Is it fair to say that the picture will be very different, maybe at the end of the next 2 years?
Of course. If I share with you our philosophy of penetration is that once we enter a state, we concentrate on few of the centers, understand the demography, and then spread our wings to the internal places in the hinterlands and the tier 2 and the tier 3 places of that state. So the way we have developed Gujarat over a period of time, we like to develop all other states in a similar fashion.
Okay, so the share of 4 states, which is 90%, can reduce to what, sir, maybe in the next 2 years?
Post?
So you have about 4 states which are contributing to 90% of your branches, right? So will this mix remain the same, or it will change substantially after 2 years?
No, of course, as we expand our branches at other centers, the share will change. So it is difficult to exactly put the percentage to that, but maybe what is 90% right now can be around 60 to 70%, and then we would like to be more or less evenly spread going forward, with Gujarat being slightly dominant.
Sure. And does this have a material impact on your OpEx, or you think that with higher direct distribution, NIMs will offset the impact in OpEx?
Yeah. Our NIMs will improve as well as our OpEx will increase. So will be the credit cost, but our ROAs and ROEs will be stable.
Okay. Okay. Great, sir, and all the very best. Thank you for answering.
Thank you. Thank you.
Thank you. We have our next question from the line of Avinash from Brookfield Estate Private Limited. Please go ahead.
Right. Hello.
Mr. Avinash, please use your handset mode.
Hello.
Yes, please go ahead.
Yes, we are.
Sir, my question is regarding the housing finance. In terms of AUM, where do you see the housing AUM to reach maybe in the next 3 to 4 years?
I think I would like to see this housing AUM within next 3 years to be anywhere between close to 1,500 to 2,000 crores. Because if we take a 35% growth, 30 to 35% growth, and an optimistic number of 35%, I think we should be closer to 2,000 crores within next 3 years.
And this is without further investment into the company, or it's just that organic growth from the reserves? I'm just trying to understand.
Housing finance housing finance currently is getting the capital from the parent, and we see that within next 3 years, if we visualize for next 3 years, parent will be in a position to infuse the capital as and when it is required.
No, so to get to 1,500, what I'm trying to understand is to get to 1,500 crores, how much capital would need to be infused? Those are the questions.
I think for 1,500 crores, roughly, if we consider in housing finance company, the leverage usually is anywhere between 5 to 6. So accordingly, for 1,500 crores, the capital required will be anywhere close to 250 to 300 crores. and we are currently at around 100 crores of capital. So another 150, 200 crores will be infused.
Will be needed for Dewan Finance.
Yeah.
Understood. Then that's all. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and one on your phone now. We'll take our next question from the line of Aditya from Securities Investment Management. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. So, we have been, seeing strong growth in our salaried personal loan book. So if you could just throw some light, how is this book behaving as compared to the other book?
See, as shared in the opening remarks, the salaried personal loan is around 5 to 6% of our overall AUM. We intend to keep it well below 10%, and we are focusing on that with due caution on the quality of assets and the quality. And if you see the stage 3 in our salaried personal loan is
2.38%.
2.38%.
Got it. And sir, how is the sourcing being done for this book?
I think majority of the sourcing is done direct, and some of the sourcing is through DSS, but majority of the sourcing is done through the feet on street dedicated for this particular product.
Got it. And so my next question is, RBI had come out with a circular requiring banks and NBFCs to provide for the investments in AIS. So we had an investment of around 30 to 35 crores as per financial year 23 annual report. So what have we done with that investment in AIS?
That has been liquidated. That is already liquidated before the due date.
Got it. Thank you, sir.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and one on your phone now. We have a question from the line of Shrishti Jagati from Ambit. Please go ahead.
Hi. Good evening, sir. Congrats on the good set of numbers. 2 questions. Sir, could you throw a bit more light on the capital raise that you have gotten approval for? The areas where this capital you possibly want to fuel growth for, one. And secondly, as to exactly when, given the high liquidity that we already have on the balance sheet, exactly when do we anticipate the requirement of this capital to go through?
See, I think I shared this earlier that we have an enabling resolution of 700 crores and we can raise it technically anywhere over a year. But depending upon the advice and the interaction with the investors and from the merchant bankers, it can happen depending upon the right valuations and the right set of investors we get. And this is in preparation for our next phase of growth. If you look at one link of a chain at a time from 10,000 to 20,000 crores. So difficult to give the exact timeline, but it can happen soon or it can happen in tranches afterwards. And on the usage of this capital will be for the further expansion of the business, because in lending business the capital forms the base for anything. So as we enter the next phase of growth, we would like to have sufficient capital with good buffer also.
Right. Sir, secondly, I wanted to ask, you mentioned diversifying the liability profile as well. So what sort of cost benefits are we trying to reap out of this?
So the diversification of liability profile will be more from an aspect of diversified resource rather than just on reducing the cost, which will happen over a period of time as we gain scale and as we improve on rating. But right now the idea is to diversify the liability from the point of view of resources, where it is predominantly a bank-led liability to various other instruments-led liability like capital market and so on.
Makes sense. And sir, just last question on cost income again. given the branch expansion and the expansion that we are looking at in terms of diversifying our products as well to the retail portfolio, which comes at a higher cost, could you give a understanding as to how do we see the cost to income ratio move?
I think the right way to look at is the NPMs and the ROA, which will drive our pricing and the operations. So whatever product we take, they have different origination cost and different credit cost. But at the end of the day, we intend to maintain a 7% NIM with around 2.75 to 3.25% ROAs and hence the resultant return on capital employed. So difficult to give a number to cost to income ratio because it depends upon which type of products and the product configuration from time to time. But at the end of the day, that cost to income ratio ultimately has the bearing on the ROAs, and that is where we would like to maintain anywhere between 2.75 to 3.25%.
Understood. Thank you. Thanks for answering my question.
Thank you. We have a next question from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Sir, just two questions. In the HFC, you would ideally be having much higher leverage. So when we are talking about this ROA, ROE, this is for the standalone business, right? I mean, there you can have much higher leverage.
Technically, yes, but practically, as I told earlier, that banks are under, or any of the lenders are post this DHFL and all, lenders are not very comfortable going beyond a certain leverage, irrespective of the statutory requirement. So the larger HFCs, if you see, nobody crosses above 5. So anywhere between 5 to 5.5 as compared to 4 to 4.5 for housing, it can be between 5 to 5.5 going forward.
And that would be a lower than 2.75 to 3.25% range ROA, right?
Yeah. So housing on a sustainable basis, housing return on capital employed is anywhere between what I foresee right now, can change and depending upon so many other situations. But as I foresee right now, can be anywhere between 14 to 16%, and for if the more efficiency kicks in, it can be around 17% as compared to 16 to 18 or 19% in the parent.
Understood. And subsequent to this, RBI norms on borrowings towards NBFCs from banks. So what kind of pressure, if any, are you seeing on the rates and the amounts that you are trying to raise from the banks?
See, as I told earlier, RBI, if you understand RBI circular correctly, they are not against the banks funding NBFC for priority sector lending. They want to curb the lending to NBFCs, especially the indication is on large scale lending to very large NBFCs, whereby that can be connected risk going forward. But given the government's intent of financial inclusion, and especially at the micro enterprise level and the small and medium enterprise levels and income generating activities, including housing, I think which falls under priority sector, RBI is not averse for banks lending to them. But however, having said that, as we grow, we would like to diversify our liability progressively. But as of now, since majority of our assets falls under priority sector lending, we see no problems in raising funds. But at the same time, because of the overall situation and overall sentiments prevailing in the market, there can be a slight 10 to 15 bips increase in rate by the banks.
Understood, sir. All the best. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over back to the management for any closing comments. Over to you.
So I would like to thank everyone who joined this con call, and let me reiterate that we as Team Mass are dedicated to our mission of excellence through endeavors, and we are now entering the next phase of growth, and I anticipate and expect all type of support from all the stakeholders, including all of you. Thank you.
Thank you. On behalf of Motilal Oswal, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.